I draw your attention to the orange line, which is us, and it is the lowest of all the lines. We should be at the level of the yellow line, which is emerging markets. And there you can see that sort of quite considerable gap between the group that we should be belonging to and where we are actually performing.
Is the global economy finally emerging from the COVID-19 crisis? Well, in this clip from an exclusive client webinar, CRA Director John Endres identifies a number of economic indicators which suggest that the world is reopening. If you enjoyed this analysis and you would like to book John Endres for an exclusive client briefing, get in touch with us via the link in the description below. Enjoy.
We come now to the global part of our briefing. And we have a couple of sections. The first is the pandemic world. Of course, COVID is still very much on the radar. We'll take a quick look at where we stand on that, and then we'll move into the longer term trends where we think that financial aspects of the world economy are particularly interesting at the moment. So is the world reopening? Let's take a look at some of the statistics. So the first data point we look at is the number of global international flights between January and August for 3 years. The red line is 2019, so that's pre-pandemic air travel. The yellow line is air travel during the pandemic year, and there you can see that really big dip in the number of flights. And then 2021 is our first year after the pandemic, and we can see that air travel is back close to where it used to be before the pandemic. But it's just slightly lower still, but comparable, and we see right at the end of that curve that the red line and the black line are meeting. So it looks like that is pretty much back to normal. Okay, then we look at GDP growth rates for some world regions: China, SA, the United States, emerging markets, and the European Union. Going back from 2007 to the present, I draw your attention to the orange line, which is us, and it is the lowest of all the lines. We should be at the level of the yellow line, which is emerging markets. And there you can see that sort of quite considerable gap between the group that we should be belonging to and where we are actually performing. You also can very clearly see the global financial crisis dip at the beginning of the curve, and then the COVID-19 dip at the end of the curve. Most of the world seems to have found its way out of the pandemic economic depression and back into familiar growth territory.
Enjoying this analysis? Click here to sign up for our 30-day free trial for more content from the CIA.
Okay. So then we look at consumer confidence. These graphs go all the way back to 2000 to the present. And it is, I think, the end part that is particularly interesting. So you can see where the COVID-19 confidence hit occurred during 2020, quite deep dips in confidence, but a strong rebound in the red line, which is China, a strong rebound in the orange line, which is the euro area, and for me, surprising, a rebound, but not as quite pronounced in the United States. So look at the US dollar index next. This is an expression of how strong the dollar is performing against a basket of currencies. This chart goes all the way back from 1990 to the present. We see that the dollar strengthened quite a bit during the early 2000s, then fell quite steeply into the mid-2000s, and then rose back out of that in the 2010s, and has been at a pretty constant level between 90 and 100 on that index level. Okay, so on this chart, we've got 8 charts, commodity prices and the Baltic Dry Index, and these are for us indicators of demand in the world economy, and they are price indicators. So we see that many of these prices, which are being measured from the beginning of 2020 all through to the present, have been rising. That is true of copper. Gold rose, and then dropped a bit. Platinum rose, it's been dropping a bit, but aluminium is strong. Brent crude oil is strong. Coal has tripled in price over the past year. And the Baltic Dry Index, which is an index measuring the cost of shipping bulk goods around the world, is also up. So these charts are showing us that growth is not as uniformly strong as it was at the beginning of this year. We're seeing some signs of trouble in gold, platinum, and the iron ore price. Each of these has its own story, but one story I would focus on is energy costs. because oil, coal, and gas have all gone up very steeply this year. And partly this is because the demand for electricity is rising quite strongly, around 45%. And so all forms of energy are seeing spikes in demand. What's interesting about this is that fossil fuel prices are increasing. So if you consider that we're living in a global environment that is very much focused on green values and on getting away from fossil fuels, these charts are not showing that at this stage. Here we're seeing that fossil fuels are still very much in demand. And I think that this transition will take longer than people expect it to take, because renewables are a little bit unreliable. Nuclear is unpopular. So that leaves you with fossil fuels. You'll probably keep going back to them for a while. The iron ore price is also very interesting because the world's biggest importer is China, which I think imports 8 times more iron ore than the second-ranked importer. And so whatever happens in China has a huge impact on the price. And the Chinese government has been quite interventionist in recent months in the economy, across the tech sector, but also across other sectors like real estate, for example, where we see the Evergrande story at the moment with a possible default of one of the biggest borrowers amongst property development companies. And iron ore is one of the ingredients that they use to build buildings and to build infrastructure. So this might be a sign that there's a doubt about whether Chinese demand is going to hold up in terms of overall growth, but also in terms of specific industries, like, for example, the real estate industry. And aluminium, I'm not sure why that is not moving in cohort with iron ore. I guess it's used in different products, and demand is still high. So those prices are still holding up quite well. So here what we're looking at is from 2010 to the present, the difference between the yields in South African 10-year bonds and United States 10-year bonds. And what this tells us is how risky South Africa is considered to be as a capital market and as an investment market. The United States 10-year bond is considered to be a very safe bond. So a very low premium is charged on it. But South African debt is considered to be more risky. And you see that reflected in those yield differentials, especially over the last 10 years or so. That towards the end of that period, you can see that yield differential really spiking up quite strongly. So we're paying a lot more for our debt than we did in the past. Also see the South African to American US dollar exchange rate, which has come down quite a lot. So that represents a weakening of the rand when that line goes down, and it means a strengthening of the rand when that line goes up. We've inverted the scale on the right-hand side to make it come out that way. The rand since middle of last year has strengthened quite a bit. I think that was maybe also counterintuitive, a little bit unexpected, but that probably is driven by demand for South African resources and commodities as the world economy came out of its recession. And we sold a lot more commodities than we did before, which of course also has an impact on our fiscal position as the government collects much more tax revenue than it expected to collect because of the strong commodity prices and exports.
Thanks for watching. Please leave your thoughts in the comments section below. And also don't forget to like this video and subscribe to the channel. And do get in touch with us if you would like to book a CRA briefing for your board or management team. My name is David Ansara. Until next time, take care.